So good afternoon, everyone. Thank you for coming. I'm Julieta Henke. I'm your sales representative for Miami and Latin America. I'm going to be your host today, so thank you so much for being here. I believe that this is a very special moment for all of us. After all these difficult months during the pandemic, all the lockdowns around the world, not being able to gather, now with this new Zoom and new virtual thing, so it's important to be here. We are sitting together. We are seeing each other. So I'm very happy and grateful to see you all. And again, thank you so much for coming and to joining us. And I hope that you really enjoy this program. I want to thank and I want to welcome all our streaming followers. So thank you to Fan Society because they are streaming this. We have more than 200 people following us online. So thank you again for helping us to promote this event. So we have a pretty tight agenda today, but before jumping into it, I would like to introduce your Robeco team. So Ana Claver is my boss. She is sitting there. I don't know, maybe Ana, if you wanna say hi, then she's gonna be here. She's the head of Iberia, US Offshore, and LATAM. Also, Sonia Perez Castro from our marketing department in Spain is here joining us, is sitting there. Mauricio Bernal, he's my assistant. Maybe you know him. You should have been receiving his emails, so now you can put a face to those emails. Mauricio, I don't know where's Mauricio. There. And Jason Geidler covering New York and the West Coast. He's sitting there. And our guest speakers today is joining us, Jack Neely. Jack is the portfolio manager of our Global Consumer Trends Funds. He's going to be joining us remotely because he's sitting now in Rotterdam. And joining us in person is Ed Verstappen. I think that everyone remembers Ed because he has been in Miami several times. He represents all our trends funds. And also Nicholas Benetton, he's the client portfolio manager for Robeco SAM, meaning Sustainable Asset Management, covering all our sustainable products. So, hold on. After the speaker, I think that this event can provide you I hope that this event can provide you with inspiration and with guidance in this changing world that is facing long-term disruption because of all the global warming and all the climate change and short-term disruption from the pandemic. So the key question here and the key question for today is why trends? Why sustainability? Why we think that is important? And we want you to know and to understand that this is not something fancy or something cool, or the flavor of the month. This is something serious. This is something that is happening right now. We need to take conscious about this. We need to start to talk to your clients, because if we don't do it, someone else will, and we don't want to miss this opportunity. We need to take in consideration, not us, but the future generations, millennials, Generation Z, your children, your grandchildren. We need to be on top of this. You need to start to have this conversation with your clients. Start talking about sustainability. Start talking about digitalization, about the environment, and the trends that are here to stay. We think that that's very important, and you need to start having those conversations. If not, someone else will do. So please be on top of that. We are facing the fourth industrial revolution. What does this mean? That digitalization and sustainability will lead the way of innovation. That there is no doubt about it. So I hope that our insights can give you clarity to make the right decisions and give you some talking points that you can share with your clients. So the future is in our hands. The future is sustainability. The future is now. So welcome again to our Robeco Megatrends event. So now we are going to move to the first part of the presentation. This is going to be done by Ana. Ana is going to be interviewing Jack. Jack is in Rotterdam. And here we think that the main important thing for you is to understand what are the trends that are shaping the world today, especially after COVID, and what trends are here to stay. And obviously, we're going to be addressing what is going on with global consumer trends. I think it's one of your top holdings. So we want to make sure that you understand, that you can explain to your clients what is going on with performance, not only for this year, but looking forward to next year. So with that, I'm going to turn it over to Ana. Thank you.
Hello, everyone. Thank you, Julieta. And I think before giving the floor to Jack, I would like just to say some words to all of you here today. It seems quite clear that today's megatrends have been reinforced by the pandemic that is impacting all of us nowadays. That's why Zoom, Teams, I think Julieta was mentioning before, at least in my case, it has been the only tools that I have been able to use lately since I'm able to take the responsibility of the US offshore market. I took the responsibility 1.5 years ago, beginning of last year, and all the contact that I have with these teams, with these regions, with these clients, has been up until now virtually. So this is why, for me, I'm so glad, I'm so pleased to be here today in person with all of you. I understand now, when I was coming to this wonderful place today, I understood why, because I have to recognize that I was looking forward to come here not only 1.5 years ago. I think I really wanted to come here time ago because the relationship with the Robeco Miami office has been always very stretched. And I understood today, this morning, when I was in the taxi coming to this event, why all the excuses that I was giving to my manager at that time were not listened. And it's because once you are here, once you know this wonderful place, such as great people, this landscape, this weather, you really don't want to come back. So today, I really understood why now is my first time that I'm here in Miami, but hopefully I will be able to come back very, very often. So first, I would like to thank you, all of you, that you have made your effort to be here today with those busy agendas. So thanks to our clients for your commitment, for your trust. This is very, very important for Robeco and for all of us. So thank you for being here. Thank you for your support today and always. I would like also to take the chance to thank the Robeco US offshore and Latin team, Julieta, Jason, Mauricio, Jessica. Thanks a lot for all the good work that you have done along these years. You have put Robeco in the map, and not only in the map. I think nowadays Robeco is one of the main international asset managers here in this region. And that's why I'm also here today to reinforce our commitment with this region, with this market, our commitment with the US offshore and Latin markets. For Robeco, this region, these markets are becoming a strategic business unit for Robeco worldwide. So that's why we are in the process of strengthening our team and hopefully onboarding new talent, new people, new ideas, new content that you deserve. So this is a new era for the world, and I think it's also a new era for Robeco. And we would like to walk the walk together with you, bringing the content, bringing the ideas, bringing the solutions, and continue partnering with all of you. So the aim of today is to push Robeco, Thematic, and climate boundary solutions to the next level, because we are convinced that they are here to stay and they are shaping our shared future. So thank you so much. I'm going to give the floor to Jack Neal. I think Jack is supposed to be there virtually. Hello, Jack. How are you?
Good afternoon. I'm very well here. I'm at the Rotterdam office. I hope I can be there in some physical form next year, but for now it's unfortunately it's in digital form. But looking forward to come over to Miami and see you all in person, hopefully somewhere soon.
Okay, Jack, it's a pleasure to have you here, even virtually. And you are a very well-known PM. You are the rock star PM at Robeco also. So thanks a lot for making the time. It's very late in the Netherlands. It's very late for Europe, but for the Netherlands, I think it's even later. So thanks a lot for your effort to be here. And we are talking about trends, mega trends, shaping the future. So, I mean, it's really great to have the opportunity to talk to you, Jack. I don't know if you just can elaborate what are the trends that you foresee in the short future, and if Some of them were previously before pandemic, or I have been reinforced. What is your point of view and how you are translating that into your fund?
Sure. Yeah. Thanks a lot, Anna, and welcome to everyone from my side as well. Great that you are all here, whether physically in Miami or joining via stream. I think that with regards to how the world will look post-COVID, I sincerely hope, by the way, there will be post-COVID, because it seems for now that COVID is something that we'll have to learn how to live with, because it seems unlikely that we will. Soon be completely rid of it, to be honest, but it's definitely something that has really accelerated some of the most powerful trends that we already have seen. So I don't know whether the world will be very difficult, but it seems very different. But it definitely seems that it will be a lot more digital than it was pre-COVID. And some of these trends have really accelerated over the past 18 months. Take example, for instance, digital payments. That was already an area that was of interest for our portfolio. And due to the pandemic, of course, people have been very hesitant to pay with physical bills and coins because of the hygiene factor, and many people have used contactless payments or have used things like Apple Pay, for instance, to pay with their smartphone. And I think once you've used, let's say, contactless or paying with your smartphone, you're probably not going to go back to paying with bills or coins, or checks, for instance. And we think that the digital payment space has really been accelerated during 2020. Obviously, we've seen a little bit of a slowdown in 2021 as we've seen a little bit of a reopening of the overall economy in many countries around the world. But it's definitely something that's here to stay and will accelerate further in the next 3 to 5 years. And I think the same holds, for instance, you see, if you look at this slide, this is a bit the investment universe of global consumer trends. You see, for instance, the future of commerce subtrend that we have within the orange brackets. So the orange brackets denote the digital transformation subtrend. So if you look at the future of commerce, that includes online meal delivery companies, it includes last mile logistics companies. You've definitely seen a big shift towards online in 2020, benefiting companies like Shopify that provide solutions for businesses to go online. But it also has led to us ordering a lot of stuff to our house and to our homes, and that's not just food, which companies like DoorDash offer in the US, or Delivery Hero in many countries in Asia. But you can see that it's slowly expanding to all types of categories. Nowadays it's not just food, but it's also going to be groceries. Maybe it's going to be convenience store items, and basically everything that you could ever wish to get delivered to your home, you can probably now get delivered. So we think that these companies are forming part of vital infrastructure. The final point I'd like to highlight in this at this point is healthy lifestyle. Of course, the pandemic has led to a significant change in how people look at their health. It's probably been the most important thing people have been looking after over the past 12 to 18 months. And so we see that companies, whether they provide sporting goods or whether it's healthy ingredients that go into the food people eat, also on the personal care side with cosmetics, etc., you can see that people are spending a lot of effort and therefore also money into treating themselves well. So we think that all of these trends have in part been accelerated by the pandemic and have definitely staying power and will determine and shape the future over the next 3 to 5 years as well.
Jack, and also related to the trends, what are the latest trends that you have included in your, in your portfolio? What have been the recent or the most recent changes in terms of trends in the portfolio?
Yeah. So if you look at, for instance, subscription services, I think that's going to be a relatively new item that we've added to the portfolio. It's in part induced by the pandemic, I'd say, because during tough times, people value the simplicity, let's say, of these subscription services. And of course, people have been getting used to services like Netflix and Spotify for their music. But nowadays, you can get everything as a subscription, basically. I mean, my wife has flowers as a subscription, so every 3 weeks we get a fresh bunch of flowers delivered to our home. A lot of people who have cats or dogs get their dog food delivered to their home on a subscription basis. You see, obviously, everyone has a broadband subscription, and so you see most households nowadays have 3 to 4 subscription offerings, and that's in part technology has been able to provide these services at relatively low cost to people. And I think that means that as people have gotten used to have more subscriptions in their life, obviously companies are trying to benefit from that, because subscription services are a much more powerful way of connecting to your eventual consumer. I mean, if you buy a physical good or product, maybe you're going to the store and you buy it once, and once you've used it, or once it's obsolete, you buy a new one. But then it's a complete new buying decision, and you can perhaps easily switch to either a different product or a different brand. And by having a subscription service, obviously you are continually tied to that same consumer, and that means that both from a consumer perspective, but also from a business perspective, these are very powerful business models. For consumers, it's very interesting in terms of the ease of use, the relatively low monthly cost. But for businesses, it's especially attractive because it leads to recurring revenues. So companies that have relatively good visibility in terms of their future revenue and profit streams. But nowadays, perhaps more important, that it also generates a continuous data stream, because every month or every now and then you're in contact with that specific business, so you develop a relationship with their business that is much more powerful than just buying a one-time item. So we see this as being not only attractive for consumers and being attractive for businesses, but also very attractive for investors, because obviously investors dislike, in some cases, the uncertainty that comes with many business models. And these subscription services companies offer investors reduced uncertainty, because a lot of companies have increased visibility into their revenues and profits. So subscription services is definitely something that we'll focus on in the year to come. The second one, and that's been a bit of buzzword over the last month or two, ever since Facebook, the company, renamed itself to Meta Platforms, and that's the Metaverse. And the Metaverse is sort of virtual and augmented reality world where you can combine both aspects of both the digital but also the physical world. So maybe the virtual world will consist for instance, through a video game. But nowadays, through video games such as Roblox or Fortnite, you can also order your Nike shoes to be physically delivered to your home, for instance. So it's just a virtual place where people spend time, and whether that's for entertainment through a video game, but it can definitely also be for remote working. Most people, if you're working from home, you probably have a Teams meeting where you see, let's say, normally, depending on the size of your team, but you see, let's say, 9 pictures on your screen. But it would probably also be a lot of fun to go and meet each other in a virtual environment where everyone is there, and that creates a much different experience than either the current Zoom or Microsoft Teams developments. And that means that even though it's relatively early with this opportunity, Meta Platform, so Facebook has indicated that they'll spend about 10 billion on this next year. So it's definitely an area that a lot of businesses will increase their spending on. And we see also here significant opportunities for investors, because analysts have estimated that over the next 5 to 10 years, they see an over 8 trillion addressable market for companies that are exposed to the metaverse. And that can mean revenues for companies that sell virtual goods, and that can be in video games, for instance, but it can also be for the companies that build out the infrastructure that is necessary for building out the metaverse, but it can also be companies that are active in virtual or augmented reality that can benefit from this shift. So it's relatively early, but I think we've all witnessed during the pandemic that digital has become a much more important part of our lives. And so I think that it's a almost natural development that digital will undergo over the next 3 to 5 years. So subscription services and the metaverse, even though it's still relatively early in that development, I think will be themes that will become very important over the next 3 to 5 years.
Thank you, Jack. I have to recognize that metaverse is a little bit scary, or maybe at least, I don't know if it's my age or my mindset, but come on, we will see really amazing developments in that sense. So, and
yeah, I have a 1-year-old son myself, and I think he'll understand the metaverse probably better than I will. But you definitely see with young people how much time they spend online and how much time they spend in video games and what they do in video games as well, that you can definitely see that how this will develop over the next decade.
Yeah, clear. So also my other question, Jack, I mean, I think from the structural point of view, it's quite clear that this fund, this way of investing makes all the sense in a portfolio because those are the trends of the future. Those are structural trends that are going to shape our next future. But on the tactical side, that's also very important for our clients, I would like to understand what we can expect from the fund looking forward for next year, taking into account the performance attribution of this year, that it has been a little bit challenging for the fund due to this value environment that we have been involved year to date.
Yeah, so it's been sorry, I just dropped my mic here, so it's fine now.
I did the same at the beginning, don't worry.
Okay, thank you. It's definitely been a challenging year, and maybe I'll try to put it in the context also of 2020 and 2021, because for us, we tried to look at 2020 and 21 together, because we think we had a tremendously good year in 2020 because of all the trends we talked about and how the acceleration that we witnessed within those trends. And this year has been a bit of a reversal of 2020, because last year we saw an acceleration in trends, and this year we've actually seen a deceleration in growth. So if you look at e-commerce, obviously during the lockdown, everyone was ordering stuff to his or her home. The same with meal delivery. When restaurants were closed, we were all ordering online our food to be delivered to our home. And we've seen a big slowdown this year. We saw growth rates in 2020 of 150 to 200% for some of these businesses. But we've definitely seen that come back to earth. And that sort of big V-shape also that we've seen in the economy, right? So a big drawdown in economic growth in 2020 with a big recovery in 2021. Almost the reverse is what we've seen in the digital trend in the stock market, with a big upswing in 2020, but also a drawdown in 2021. So if we look at, maybe we can show the slide on the performance that I've shown here in dollars over 2020 and over 2021. If you look at the top right, then you can see 2020, a tremendous return for our strategy versus the index. And in 2021, a relatively poor return for our strategy relative to the index. But if we look at it over the 2 years combined, you can definitely see that we're still way ahead of the index over 2 years. And we think actually that over the next 2 to 3 years, let's say leaving the pandemic behind us, will be a relatively good thing for the fund, because we look at structural growth opportunities, and I think for many companies, but also for investors, they like to see companies that are on a structural growth path, and they don't like to see an acceleration to 100% growth in 1 year and then a deceleration back to 20 in the next year, because it provides them with uncertainty. And we also prefer to have our companies growing 20-25% every year instead of an acceleration to 40 and a recovery back to lower rates of growth. So I think that consistency that has been missing over the past 2 years, and that has led to a lot of volatility. So if you the graph at the bottom right, it shows the biggest contributors to the performance in 2020, but also their performance in 2021. And you can see that a lot of outlier returns, let's say in 2020. We've seen a lot of companies actually doubling or even trebling. If you look at companies like Square and Chewy, for instance, Chewy is the online pet food company. Square 250% rise in 2020, and some of them, well, close to 150% as well. But almost all of them have seen a drawdown in 2021 due to the slowdown of the growth. It's not that they went into negative territory in terms of growth. It's just that the growth rates of 2020 were unsustainable and have been coming back to earth. And for investors, that provided them with basically a lot of uncertainty about where the growth rate would bottom. And I think that's why it's really helpful that we end, let's say, 2021, move into 2022, and get to more sustainable growth rates for these companies and leave the volatility of the past 2 years behind us. And besides, let's say, these points, I'd also like to highlight a couple of things that went well and went poorly, let's say, in 2021. So we've seen the digital consumption theme in itself remain very strong, with very strong performance for semiconductor makers like Nvidia and AMD. Nvidia shares even more than doubled. You can see in the slide on the graph on the right. Small business exposed companies like Shopify and Intuit, as I explained before. Small businesses use the pandemic, or a lot of companies have used it, or a lot of consumers have used the pandemic to develop their own small business. So we've seen small business formation actually grow in an accelerated manner, and companies like Intuit and Shopify have really benefited from that, providing solutions for many of these small businesses. And also one of the themes of this year, I think, has been the almost unexpected, to some extent, performance of the big tech companies. Microsoft, Google up 50 to 60% this year, even though a lot of the NASDAQ stocks have had quite a difficult time. We've seen big tech actually performing extremely well, and we'll see whether that is the case again next year. But the fundamentals of these companies remain strong, but there have been a bit of a narrowing of the breadth in the overall market, with the big cap tech stocks doing extremely well. But if you get to the mid cap stocks, they've done a little bit worse, and the small cap stocks have done even worse. So we've seen a big discrepancy, let's say, in the overall market, where the overall market is driven obviously by the big companies, whereas the smaller companies have definitely performed much less well. The second element is health and well-being. That has really proven to be the defensive cornerstone, let's say, of our portfolio. One of the drawbacks here is that it's the fact that it's defensive is obviously very good, but in a market that's up double digit, or if you look at the S&P up 20%, it's hard for many of these companies to keep up with those types of returns. So we've seen solid returns in pet care from our investments in IDEX and Zoetis. Also, the food ingredients companies in Europe have performed very well, but obviously not as much as the overall market, but they've definitely proved their defensiveness. Also, the cosmetics companies like L'Oreal and Estee Lauder have performed pretty well. And finally, probably the bigger disappointment this year has been emerging markets and our emerging middle class theme. I think emerging markets are the only region this year that are in negative territory. Crackdown on technology that we have seen impacting companies like Alibaba and Tencent, so the big tech companies from China. To some extent, that weakness has been offset by strength in luxury goods. So companies like Louis Vuitton or Richemont, that owns the Cartier jewelry brand, those have been very strong, as we've seen a lot of consumers treat themselves well during the pandemic, and that has definitely benefited the growth of these businesses. Maybe a final remark on the overall performance. Obviously, you can see this year it's disappointing. I think emerging middle class is one of the major reasons for that disappointment. Of course, also value sectors like energy have done well, but obviously we don't invest in those sectors, so that's not an area we can do much about. But so it's also not something that I would be willing to use as an excuse. But I think we've also made some mistakes this year, and that we probably bought some of the lockdown stocks too early. So think Zoom, it was already down 40 to 50% since the peak when we entered the stock. But given the slowdown that we have seen in the overall growth rate, investors obviously consider that to be a little bit too early, as the stock has been weak in the last 6 months as well. But we think it's definitely a company that's part of the new world. Even if we all go back to the office, probably it won't be for 5 days a week. So we'll probably still use video conferencing, and a lot of businesses will have a subscription for video conferencing, and Zoom is the natural beneficiary of that. And then maybe the final mistake, so to say, is that we recognize the increased competition or competitive intensity in the food delivery market a little bit too late. So we were invested in companies like I mentioned DoorDash before, but we also were invested in Uber and Just Eat Takeaway, for instance. The latter two we've in the meantime sold, because we've seen a lot of new businesses coming up that are trying to deliver goods to you in 10 to 15 minutes. You've probably seen that in the US as well. Gorillas is a very good example here in Europe. And I think that many of these business models are still relatively early, so they're investing a lot, and that has also meant that the negative effects, let's say, from that competition has definitely led also to the big players to continue to invest, and that obviously has delivered losses. And we have seen that the market is currently not in a relatively forgiving mood with respect to companies that don't deliver on the expectations. So we've really cut the weight in these companies, but to be fair, we've done that a little bit late. So besides, let's say, the weakness in emerging middle class, also some of these mistakes that I've mentioned have led to the lower performance in 2021. But we think that because of the changes that we made this year, so increasing some of the highest conviction companies within our portfolio, increasing the weight in these companies, and by focusing on these structural trends, that the portfolio is relatively well positioned for 2022 and beyond, especially if we come into a little bit less volatile environment from a growth perspective, because I think investors really like companies that are growing their revenues at a relatively stable pace, instead of, let's say, the more volatile growth period that we've seen in the last 18 months.
Okay.
I think that we have 2 questions from the audience. Jack, the first one is if you can please expand on any decision process of adding any new positions and selling existing positions. And the second one is if you have any thoughts on BABA delisting, or maybe because it has dropped so much, if you are planning to add more into the portfolio.
Sure. First, on the process of buying and selling, obviously we look for companies that have exposure to the long-term trends that I just mentioned. So if you look at the investment universe again, there's some of the sub-trends that we have within our portfolio, and so all of the companies need to fit within these trends and be in a dominant position within their respective end market. So what we like are the so-called structural winners, the quality growth companies that are in a dominant position, that have a competitive advantage versus their peers, and that can grow structurally over the next 3 to 5 years, and we expect, if they grow their revenues and earnings structurally, that also the share price will over time show that return. And from a selling perspective, we generally only sell if the fundamental trend has been broken. Although I must say that more recently we also sold Activision from our portfolio. I don't know whether people have been following it. It's obviously a gaming company which is relatively well known for its Call of Duty franchise, and we've sold this one for ESG considerations. I mean, there's been many stories in the press about Activision not treating its female workers well. Obviously, the management has, as it turns out, turned a bit of a blind eye to that situation. So the company is now heavily criticized, and I think it will probably need an executive overhaul, and there have to be massive changes at the company. So we think that due to this scenario unfolding, we have sold the position in Activision last month. So normally it's because of fundamental reasons where we no longer have trust that the company can benefit from the underlying trend because of a new competitor coming in or changes in the underlying market. But we've also seen, and that's probably also something that we'll see more in the future, that ESG considerations are also can also be a basis of selling a company.
Okay, Jack, thank you so much for your time. You were mentioning just very shortly the ESG approach that you also take into account. I would like also to emphasize that ESG approach, because it's not only the approach that you put in place in the process, it's also the results that you are able to get. I know that you don't have the slide in front of you, but I would like to remark the environmental footprint of this fund. I mean, the environmental impact that you are able to create in this fund, that is really much, much better than the benchmark. You are able to have even a 40% reduction in CO2 emission, in water consumption, electricity, and so on. So I know that that's something that maybe is not very well known about this fund, but I would like just to remark that with the good results, you are able also to create a very good environmental impact. And that's something that is very remarkable. So congratulations, Jack. Thank you so much for your time. It has been a pleasure to talk to you. Thank you so much.
Thank you. Thank you, Anna. Thank you, Julieta, and enjoy your day.
So now we're going to move to the second part of the presentation. We are going to talk about trends. So this part is going to be done by Ed Verstappen, client portfolio managers of all our trends funds. Ed has been in the firm for more than 10 years, and he's based in Rotterdam. So here I basically want to highlight 3 things that I think that are important, which are the mega trends that we believe are shaping our future. So the first one has to be with all the changing technology. The second one with the changing socio-demographics. And the third one has to be with the preservation of the planet, of the Earth. So I'm going to leave you with that thought, and I'm going to move to Ed so he can better explain you.
Thank you, Julieta. Before I start, do you see me here with this circle above my head?
You look like an angel.
I look like a holy person. You better not believe it. Quiero disfrutar la vida loca. So anyhow, let's go. Can I see the slides here, please? What will I be talking about today? Much on why do we believe trends investing can work as an investor in terms of making money, but also benefiting from the structural change. And another more theoretical topic for me can also be, how do you put these type of funds in a portfolio in terms of asset allocation, and how have I seen that with different clients all over the world. So that's a little bit of theoretical presentation, but I think you'll still appreciate it, and I'll use examples of funds that you know or funds that we think can be interesting to you. First of all, trends and thematic funds, if you see these graphs, they have been tremendously popular. The growth has been very, very fast. So the number of assets in these funds have considerably grown. And You always have to be a little bit careful with these numbers because it's definition dependent, but we also understand very well the reasons why these type of funds have become very popular. The most obvious one is performance. Many of these funds have been outperforming tremendously compared to more traditional benchmark-oriented funds. So that's always a good reason for a client to be interested, of course. But there's much more. Anna just mentioned a good ESG profile. Many of these funds score well on low carbon emission and low water use. That's also appreciated, surely in the institutional world, but more and more also in the wholesale environment. Another thing could be that it just makes sense. And what do I mean by that? Many investors, and maybe I will upset some of you or some people, but many investors have more traditional approach. So you might look at traditional sector definitions, but then you might miss out on a lot of opportunities. For instance, stocks like MasterCard and Apple always used to be and still are technology companies. So if you would only look at a benchmark definition, then you would miss out on these companies if you run, for instance, like us, a fund that is consumer-oriented. So the sector benchmark definitions can actually hinder your freedom to invest in the best companies that you actually think that they are consumer-related. The same is with regional allocation. Many clients are overweight US or overweight Europe, but then I think it's good to realize if you buy a lot of European companies, you might have the luxury companies such as LVMH and Moncler. And actually they are very dependent on China, high net worth individual consumers. So your risk really is not the European risk. The risk really is still the China risk for those companies. So we try to prefer to look what the company is really doing instead of what's in the benchmark. And the good thing for, I think, for people like you can actually be that you always have great stories to bring to a client. We try to help with that by publishing articles on streaming media, on meal delivery, on the future of e-commerce. So you have always topics to talk to a client about, and most clients will understand the type of companies you invest in. So that makes your advisement role a very important one to clients, but also a fun one to do. If we then look at what type of funds are being introduced, this graph you see here, for us it's on one hand positive because we see huge growth in thematic and trends offering. On the other hand, this graph is also, to me personally at least, quite scary because you see so many funds and ETFs launched, and then we have to wonder if that is sensible. I remember very well an example that I really disliked a couple of years ago. There was blockchain was becoming to be a hypey big topic a couple of years ago already. Not like today serious, but actually still in the hypey phase. And there were ETFs launched around blockchain. And we looked in those products, and for instance, Santander, which is a good bank, but it was in the blockchain ETF. Well, we know very well Santander is doing a great job with blockchain today. But the stock price will not be driven by that topic. The stock price is driven by, can they pay dividends? Is it allowed anyhow? Is the interest rates going up or down? Those are factors that really determine a stock price like Santander, and not the blockchain topic. So the purity of the topic compared to the companies you really invest in is something that we always need to be careful with if you look at many new products. And the fact that so many funds have been launched can also be, let's say, proof or indication, let me put it like that it's overhyped with these type of topics. And that is very relevant because within Robeco, we try to be very careful when we launch new funds. Basically, we only launch when the universe is big enough, and often that is not the case in specific segments. When we think we have expertise, we cannot be good in everything, so we can only launch something if we have the right people to do that, and if it is interesting for our clients in terms of monetization. So these three factors are most important. This graph, I'm sure our people will send the presentation to you later, but it shows a little bit on those topics. We don't launch funds often. The last one was in 2017, and today I'll show you a new one that we also launched recently. Let's look at what we really are talking about. What is actually trends and thematic investing? The key word is this one, structural change. That is what we really want to benefit from. The word structural falls a lot here. And then, what do we mean by structural change? If you look at this picture, this is what the street looked like in 1916. And this is what the street looked like 100 years later. The newspaper had completely been replaced by things like smartphones. Then, look at this picture. China in the 70s. All people on bicycles, a lot of them. Today, or later, many cars and also environmental issues. So that's also a structural change. Another one. This is New York. I was just in New York. This is a street in, I believe, 1901. A lot of carriages by horses. Only 10 years later, you see the street looks like this. This is literally the same street. So here you see, only if you really look really well, you find one horse. And the rest are all what we call today cars. And this is what we call structural change. In our days, you know very well, and I'm sure nobody will argue with me, a big structural change has been the smartphone. We are quite addicted to it. We can hardly work without the smartphone anyhow. I'm now at the moment nervous because my battery is lowering. So that's the sentiment I have. So structural change, very relevant. And then for us, it's important that we can monetize it. And I'm going to explain now why we think you can outperform other investors by focusing on trends. Because the investment world is with so many smart, intelligent people. So how can you outbeat all those other people too? Not because you're smarter, because it's quite difficult to be very much smarter than most other people in this industry. The average is already very smart. So what we need for that is actually research. We do a lot of research on specific topics. When we did a white paper on blockchain, nobody knew what blockchain was, but we already were researching it. Now it's a serious topic. Let's say 5 years ago, it was a hype topic, but you still already had to research it. And then a thing that is also very important in our psychological minds is that investors, we believe, they tend to think linearly. But a lot of growth trends do not develop linearly. They develop exponentially. By linear, I mean things like what comes up must fall down, or retracement or regression to the mean. You hear those things a lot. Many investors are focused on these topics. It's a matter of linear thinking. In trends investing, I'm not saying this is wrong, by the way, but in trends investing, this often does not work because linear growth is very important. Can I ask you, sir, for one paper of your book, just one? What is exponential growth? I have a great example, at least I like it. Look at this paper. What if I fold it in 4? And what if I fold it once more in the same direction? What if I would do that 46 times? How big do you think this paper will be? The answer is, and you can Google me on this, and what Google says is always true, you come from here to the moon. Because I'm continuously doubling the thickness of this paper, and then after 46 times, this is just a small paper, I come to the moon. Google it, you'll find it. And that's what we mean by exponential growth, often underestimated. In these times, people know better, unfortunately for a not so good situation, because the virus can also grow exponentially. And that is what makes it dangerous. It doesn't grow linearly, it grows exponentially. You can contaminate 5 people, and those 5 people will also contaminate 5 people if things go wrong. Exponential growth. We all know this topic very well by now. So, a little bit of theory here, and I think this is quite an important slide, although it's theoretical. So I'm going to be a little bit of explaining this. Look at the blue line, that's the linear growth. We all recognize that, right? The orange line is more what we see in reality when new technologies come up. This is the very famous S-curve, you recognize the S-curve of innovation. And what you then see if you put the 2 lines together, it's very easy. In the short term, people have a tendency to overestimate that new technology. This is also what we call hypes. Luckily, in the longer term, people tend to underestimate the potential of a new technology, of a new trend. Why has it been possible that iPhones could be sold at such high margins for such a long time? How is it possible that a company like Amazon, which is not a new company, can still grow with these high numbers? People underestimate structural change. And that's important because as an investor, if you then take the long-term view and you really are disciplined in that, you can outperform other investors that are often either too much into hypes or underestimate the long term and maybe take profits very quickly. That's always nice to do, but you might miss out on the future opportunity. This is not what we invented. This is Amara's law. You can also Google this. People underestimate in the long term, overestimate in the short term. And if you then do time arbitrage and you are a long-term, really oriented investor, you can outperform other people. And that's what we call benefiting from structural change. The famous Gartner hype cycle is also a concept that relates to it. I think people realize very well if something new happens, often it first goes through a hype phase, and only after that you get that long-term growth. And let me give you one company example. The Gartner hype cycle is not on companies, but I'll still like to show this example. This is a graph of Amazon longer term. You almost recognize the Gartner hype cycle in the stock price. So, to be a long-term investor, can you always stay with the same investment case then? Probably not, surely not. We, last time in our consumer fund, last year, we had an issue with the Chinese stocks. Everybody realized that. The education sector in China was probably the most impacted one in terms of scrutiny on regulation. And the business model for these companies is completely vanished due to new regulation. So in that case, it was a good trend in a good area, but suddenly, because of regulation in this case, the trend is completely gone. And then you have to sell that company, even though it's not the company's fault, it's really the trend that has disappeared. So this is the example we owned in Global Consumer Trends, Tel Education, China stock on education. We sold it not nice because we took quite a loss, but we sold around $50 US, and today I think it's even below 10. Because can you expect it to return? Difficult, because their business model is very much gone. They need to reinvent themselves, literally. And then we try to do a lot, and Jack spoke about that a lot too. We try to find diversification, if it's a good fund. Obviously, this is what you all agree on, I hope, that diversification can lower your risk, and trends develop different in time. And then if you combine several, then you can lower the overall risk. That's important. At least that's what we believe in. There are also investors that want to play one small trend. And if you time it really well, that can be great. But that's not what we've been good at. We have been better in making a diversified portfolio that diversifies over different trends and then outperforms in the long run. That's what we really think we should be able to do. So what are the three trends we see mainly? And Julieta mentioned already a few. Trends driven by technology, such as robotization or the ongoing digitization. Trends driven by changes in socio-demographics. People get older, but there's also generational shifts. I always refer to my daughter, who's vegetarian and very healthy. She's very much focused on that topic, very different than I am. So generational shifts can really happen. And that's what we also see as a benefiting factor. And thirdly, big for Robeco, preserving Earth. My colleague Nicholas will speak a lot about that topic too, with sustainable approaches. So these are on a very high level, a classification of trends we see. And you recognize maybe a little bit of that in global consumer trends. The digital consumer, obviously, technology. Emerging middle class, obviously, more socio-demographic. Where are most people living these days? And thirdly, preservation of Earth. We take that into account in the stock picking. And then an important point, a very important point, maybe the most important one that I will make today. The trends that we describe, such as digitization and emerging middle class, they are very long-term. Very long-term. Digitalization is not at all new. When I was in university, a long time ago, we started with email. So that's a long time ago. The thing is, as an investor, you cannot only say, this is a great trend that we expect to be great for the next 20 years. It doesn't work like that. That will be too simple. You need to adjust your portfolio because the trend will also grow up. It becomes older and more mature. So in this example, for instance, 15 years ago, the digital consumer was the fact that people were buying their first smartphone. That was the big trend. A few years later, people had a smartphone, and companies like Facebook came to the market with their IPO. And they started to make money on mobile advertisements. Remember that there were zero revenue on mobile advertisements when they IPO'd. Look at that company today in terms of revenue and mobile advertisements. So you move from the hardware to the use of that hardware. In the COVID period, other topics were very relevant, such as meal delivery, or to pay not with cash, but more digitally. Jack spoke a lot about those trends. And we think going into next year, you still need to move into how the trend grows up. And then we speak about topics like Jack mentioned, for instance, the Metaverse, if we can avoid the hypiness of the buzzword, and also things like subscription economy, which is actually a more defensive part. So that is then, we believe, very relevant. Don't only fall for the story because it looks good 20 years from now. You need to adjust the portfolio because our aim is to outperform on a 3 to 5 year horizon. And I'm very sure your clients will not give you 20 years of patience, even though you might be correct, but you need to perform also in somewhat shorter term. Hopefully not every month or every year, hopefully not, but surely not, you cannot wait 20 years. So now a small break. I showed you the digital evolution, how that has went. I'm going to show a short movie, just as a break for myself, to show you where we are today with the digitization. Can we show the movie, please?
Curtains, lights, doors. It even unlocks my car. And the only one with access is me.
So this is clearly where we are today in the digital trend. Your mobile phone controls your life, your house, everything. Your bank accounts, everything. That's where we are. It started 15 years ago. Structural change. So that is a good theoretical story, I hope, but we need to bring it into fund or solutions, vehicle solutions. So how can you look at that also in a portfolio context? First of all, the keyword for us, because we are doing trend research, but we're actually an asset manager. So the keyword is monetization. We want to make money, it's as simple as that. But we do believe that trends can help in such a process. So monetization is then the keyword on a slide like this one. And I give you some examples on something else that we appreciate, not for the return, but for the risk factor. This is one of our funds. It's also available to many of you, New World Financials. Why do I mention it? Because we see lots of inflow in our financial strategy. Many investors have the view that interest rates will go up, that the Fed will hike rates, and we have worries on inflation. If that is your view, financials have been a logical thing to look at. That's what we have seen. So we have that New World Financial Fund, and it also, just like consumer, diversifies the approach. That has fintech in it, as a technological trend in there. It has also emerging finance in there, attractive markets that we believe in, such as Indonesia or also Mexico, we really appreciate in that sense, and aging finance, probably more risk sensitive. Probably the reason many clients buy this type of fund, because aging finance is about how can you collect assets to retire comfortably. Life insurers, pension providers, also asset managers or wealth managers like yourself. So here we have a lot of those examples. The key point for me is diversification. The trend is good for now technically. That's why many people buy this fund. I think we have created between 1.5 and 2 billion US dollars inflow only in this year. So it's a very popular topic, and we can totally understand why that is. It fits the current macro environment, and we have many investors that buy this tactically, because they think today, next year, it's a great topic to be in financials. But we have a new world approach to it with, again, that trend approach. Another topic is, and that you know very well, is global consumer trends. Most people have that actually as a core holding. And that is also because you see those statistical data to the right bottom, the correlation between the trends are below 1, sometimes far below 1. And that creates risk diversification. You can then calculate how you can lower your risk. So again, 3 trends, they have different drivers, they have different risk factors. That's what we do appreciate. And this strategy is actually quite broad. This is what Jag also showed you. Many topics are part of one portfolio, a one-stop solution for many attractive trends. But these topics change over time. Like Jack mentioned, subscription today. 2 years ago, we spoke about the humanification of pets. Pets are as important as your child or son or daughter. I know that, and I always like to mention that topic because Julieta bought a dog, I believe, in the Corona times. She's not the only one. So a big, big topic. The good thing is, it's very defensive because people are not inclined to lower expenses if it's on your children. And if your cat or your dog is like a child, then you're also not going to cut expenses on that. We have a cat in my house, my family. I think if she's a little bit older now, so she has to go to the vet several times. If I would tell my wife we're not going to pay for that, sorry, she would probably kick me out of the house before the cat. So I have to be very careful on that field. Broad topic. And a core holding, therefore. So our funds, this is the lineup. You know, consumer trends. We do say that New World Financial is very attractive currently, and my colleague Nicholas will speak about the green ones later. I started with one base comment, performance. A lot of these trends have had extremely strong performances, basically all of them. So if you have an interest in any of the trend funds and performance is important to you, I bet it is, then please have a look at fact sheets, etc. for performance. Very relevant. But the reason is we take a long-term view and still are flexible enough to adjust within the long-term trend, even within financials. What is a big topic this year in financials? Private equity. And we have made great returns on that, so you can overemphasize a specific topic in a specific climate. If interest rates would steepen, we would overemphasize life insurance. So you can tactically benefit by still having the tailwind of a long-term trend. In essence, that explains performance. And a lot of these funds have done better than traditional regional or sector approaches. That was also my start comment. So how can you then put it in portfolio? And I already have given away some of that, so I'll go fairly quickly over this. It depends on what you look for as an advisor or as a client. Basically, we see 3 approaches. First is you buy thematics as a core holding in your portfolio. I see that in many regions, for instance, also in LATAM, the institutional world is at the moment opening up for thematic and trend approaches. And they have had, historically, quite a big home bias. So they're now going into global equity, and as global equity, they don't want to buy a global fund that is very benchmark oriented. You might as well buy an ETF if you want that, but they want a global fund that can really outperform. And then trends and thematic can help you there. That's at least what happened so far. So a lot of those institutional professional investors, they were not really into thematics until the last 2-3 years, but now they are, and often they look for global equity strategies that are quite broad, diversified. And then you have other clients that play a trend more tactically. So then you are going to use timing and your views. And the best example is the New World Financial Fund at this point in time. Why did we get so much inflow? Because financials are quite hot, and people, and by this week we know that the Fed will increase the Fed hikes, etc. Sorry, the Fed rates. So you see to the table to the bottom, this is scenario analysis by our own risk management people, that it shows that if the Fed starts to rate hikes, that a financial can outperform. That makes sense, because the interest margin can go up and there's higher interest rates. Also, if the economic situation is good, there's good economic growth, which tends to be favorable for banks and insurance companies, actually even for asset managers. So the graph shows you that if you have the view, and you have tactically the desire to benefit from such a view, you can buy financials, because if you think interest rates will go up, that is a very logical call to make. And our fund can also then outperform, at least according to our scenario analysis. Global consumer trends is quite different. I always hope that our clients buy it for the long term. It's really like a core holding because it's already so well diversified with many companies that you know its quality. Companies like Nike, your clients often do not worry if it goes down because they say, well, it's Nike, I trust the company. There's also some psychological comfort as well. So this is very relevant as a global category. Just like Morgan Stanley Global Brands or what have you, those type of funds or global opportunities. The same. Often you buy it as a core long-term holding. We have many clients here in the region that have both funds. One of Morgan Stanley and one of us as a combination. Makes full sense. And then the reason is diversification. Again, correlations between trends, if they are much lower than one, then you can lower the overall risk in a portfolio. That's investing less than one. And then you can show these type of numbers. So you see that the Global Consumer Trend Fund, I was happy that Jack had to explain last year or this year, but I can show you the long term. And that's easier, because on the long term, the fund has really outperformed in up markets. That is what you would expect, because we are growth oriented. We should outperform when the market is doing well. But more surprising is if the markets are going down in a down month, we also go down, but much less so. So the downside risk is more protected. The main reason, diversification over 3 trends with different risk characteristics. It's very easy and common sense, but it can work. It has worked. So this is more historical data. And then you can have such a fund as a core. And then there is clients that buy a full thematic exposure. I don't see that much in the US offshore market, to be honest, but we have that a lot in Europe, where asset managers or banks start their own thematic fund of funds. And then they combine funds. So I have a client in Switzerland that was buying a few years ago already in one fund of fund, our global consumer trend strategy and our financial one. And the first years he was not happy with the financial one. He was happy with consumer trends. And he was not happy with the financial one. And that was also because the market was not good for financials. But he knew very well why he had chosen such a fund, because of the diversification benefits. So then it makes sense that one strategy might not outperform. Today he's very happy with the financial fund, and he's probably a little bit less happy with the consumer trend strategy. So that's why we like that diversification. And one thing I like you to reconsider as an extra risk factor, and it's always a big topic, although the topic is less big today than it was beginning of the year. And that is about that famous topic, value versus growth. If you buy trend funds, please be a little bit careful, because many trend and thematic funds, they are growth oriented. Many of them. Because the digital trend has been so strong, and if you wanted to have a good performing fund, probably they have done well in the digital side. Otherwise they would not have performed well. So a lot of trends and thematic funds are growth oriented, but not all of them. I mentioned already the financial fund, it's much more value, GARP oriented. And Nicholas has a fund with water, for instance, that is more cyclical, that can do better if the economic situation is really improving. So the style of a strategy, the quant style of a strategy, I don't speak about it much, I don't know that much about it, but it's important to take into account. Because if you buy only the best trend funds, you might have too much growth, you might have too much digital. Depends on the horizon that you've been looking at. So diversification can be good. And then, the conclusion is, for me, the world is constantly changing, so this is just a funny example, and I showed this to my kids, and I had no clue what it was about. So some of you young folks probably also don't know, but I know very well what I used the pencil for and the cassette there. So important. So structural change is the key word of my speech. If you allow me, just 4 more minutes, because I want to mention that this is actually not my last slide. It looks like one, but it's not. And the reason is I want to show you a strategy that we recently launched. We don't launch strategies often. For those of you that are independent or can make quick decisions, you might have a look at this strategy. It will be on Pershing hopefully very soon. Yeah. And if you're in other organizations, we need to work with your gatekeepers first. But if you have your own control, please have a look at that strategy. The strategy name is the Next Digital Billion. And what does it refer to? It's actually referring to the growth of digitization. We already have close to 5 million people that have access to the internet. They are digital, mostly via the smartphone. The fastest growth in that area, has not been in Europe and not been in the United States. That's already an old story. That growth has been in emerging markets. And we believe the next digital billion people will also be mostly in emerging markets. And now it becomes interesting, how can you benefit as a portfolio manager from that third wave within digitization? The first wave was in the United States. Started already in the 90s. Companies like Amazon are the result of that. The second wave was more China-oriented. Companies like Tencent and Alibaba are the result of that. They created also 2 trillion market cap. The American companies, more than 8 trillion over time. But it took them 20 years for the American ones. Then, the next wave, we believe, will be in emerging markets, and now something that we believe in, and I hope if you don't agree, that's also fine, but it's a view we have. That battle in digitization, it doesn't always have to be US or European companies that will win the battle. It can actually be more and more local companies from those countries themselves. And if you think about LATAM, where do you see also emissions or IPOs such as Nubank recently that will happen? Or Mercado Libre, an old example. We were buying Mercado Libre in 2011. And for 10 years, people were asking me, don't you think they will be killed by Amazon if Amazon really starts to invade their market? Never happened. So we believe local companies have the potential to also become very big because the most digital users are actually in regions like Southeast Asia and also LATAM. So that's why I think this can be interesting to you. Everybody knows about Amazon, but nobody knows maybe on Trendyol, the largest e-commerce player in Turkey. Everybody knows Visa, but you probably don't know, or maybe you do, but I assume you don't know Kaspi. Kaspi has thrown Visa out of Central Asia, Kazakhstan, within a couple of months. They do more payments than Visa does in that region. The local player is strong enough, has much talent enough, smart people that are very digital. Also, they tend to be much younger than in Europe and the United States. So we believe in this strategy. The next wave of digitization will be in emerging markets. And we don't have to be that arrogant to think that in US or Europe, we always know better and emerging markets are backward. That is totally not the case. One last question for me. CEO of companies like Microsoft, Palo Alto, Alphabet, where are they from? They are Indian. Since this week, the CEO of Twitter, where is he from? India. Just making the point that LATAM countries and Asian countries, even some African ones, have a lot of potential. And it doesn't have to be Silicon Valley that will win it. So with that, I would like to end with a short movie. Pay attention because the movie is only 30 seconds.
There are a billion reasons to listen very carefully now. Robeco is announcing something big. Meet Paula. Meet Chiara. Meet Asir. They have a story to tell. A story about a mobile wave in emerging markets. Discover our latest investment opportunity. Available now. The next digital billion.
Team here, Julieta, Mauricio, Jessica, Jason. If you can buy it already, and if not, make sure that you can. It's new, but we think it's a new trend. And we would not have introduced it if we did not believe in the topic. Thank you.
Okay. So we are moving to the last part of the presentation. This is going to be done by Nicolas Benetton, our client portfolio manager for our sustainable range of funds. Here we have, as I mentioned before, a pretty robust offering. We have funds as water, smart mobility, smart energy, materials, circular economy, healthy living. So we have a lot. And the most, Nicolas has been with Robeco for more than 7 years. He's based in Paris. And here, what it's important to us is to explain you how we approach sustainability, why we think that it's important, and how we can monetize and take investment opportunities from this side. So with that, I'm going to turn it over to Nicolas. And if you have any questions, maybe at the end, we can address everything.
Okay. Thank you, Julieta. And hello to everybody. I will try to not use the full time I was still allowed to use but I understand that you've had a lot already. So I will try to use 20 to 25 minutes max. If I have the slides, oh, it's there already, so it's only me not having it. Okay. Well. Yeah, well, I will be less close from the stars than Ed was. I don't know if it's going to be a curse, but yeah, if you don't mind then, if I want to have a clue of what I will be telling you, then I'll be standing closer to you. Don't feel I'm watching you in any way. So, yeah, I'm very glad this is the first time I'm here, same as Anna. But the risk I have, well, first, I'm talking after 2 rock stars, super popular here. I don't have any video in my presentation, I have to warn you. Probably less jokes than Ed. And I'm going to talk about sustainability, right? This was in the title. I went a bit carried away and you lost it. And the first reaction in front of new audience is not always positive. Some of you, it would be okay to admit it, said, oh, sustainability, not again. The man is going to be boring, he's going to make us feel guilty, tell us that the way we live, it's not good, that we have to change. No, I'm not going to do that, because what we do is not sustainability for the sake of it. What we do is sustainability investing from Zurich. So what we've done is to develop a platform of products that you can see here. I don't, but you can. For some part, what we call thematic funds, and that's what we will be focusing on today. And you will see many common points with what Ed has developed. Some slight differences, but that's a debate we have, and I'm glad we have other members at Robeco to debate on this. The only point where I would disagree with Ed is on the quant and factor exposure, but this would take us really somewhere else, in some other place. So we've developed this thematic platform, but always with sustainability as a starting point. That's really our DNA. Anything we do is anchored into sustainability, not because it's boring or for ethical reason, because we see, and that always was the case since SAM was created back in 1995. We see that as a massive opportunity. These sustainability challenges, we do not consider them only as threats or challenges. We also see a massive opportunity. So let's go with the boring part first. What's going on in the world today? Well, you see all these, what we call megatrends, so you could have many other ways to express them. We wanted to illustrate that with concrete examples. So we see demographic change, right? Population is growing, especially in emerging markets. More and more people, they come and live in cities, putting always more pressure on resources. These resources, to extract them, it pollutes a lot. So to find ways to mitigate this, we have to find solutions, renewables, new way to distribute energy. But all this is also consuming a lot of resources. So we will never make up for it. We can never make it. What are we going to do? Well, I would have several advices. First, don't panic. Second, call Julieta or anyone from the team. And then let's think together what can be done. Of course, just investing in Robeco funds will not sell the world. But what we can do is find solutions to it and make money out of it. So that's what we do. We are an asset management company. So we're trying to find good investment opportunities. And that's the case with sustainability challenges. So we do sustainability investing, but we also do thematic investing. We call ourselves sustainable thematic investors. Why is that? Well, not commenting so much on the megatrends that you see here. We identified 3 main ones. It's relatively obvious. You have demographic change, resource scarcity, climate change at large. That's our vision of the world, pretty close to what Ed showed previously. What really we think makes us standing from the crowd is the way we address it, because it's not because you will have identified these 3 trends that you're good to go. that you can monetize these trends. That's also something you've heard and you've seen many times today already, but this is so important. So we have 3 ingredients that we need to build consistent investment strategies for you and your clients. Commenting on those, first is innovation. The very strong common point that we have with our trends cousins from Rotterdam is this very high level of innovation that we're looking for. We are addressing new technologies, sometimes technologies that nobody thought we would ever need or would ever exist. So this very high level of innovation and technology requires a lot of knowledge and background. Well, first, to understand, and believe me, I've been working for the past 7 years with very high-level people, engineers in that field, and that's fascinating, all this knowledge in environmental or healthcare sectors, for instance. So you have to get a perfect and acquire a perfect understanding of all underlying technologies to invest. Don't invest if you don't know what it's about, if you don't understand what it's about. So this innovation, very high innovation level, is extremely important and integral to anything that we do. And that's another common point with the trends approach. You also need awareness from society to build a consistent strategy. What we mean by that is that if you're too early in a technology, then it might be simply impossible to reach the end consumer. So many of the solutions that we invest in, they are B2B. They are industrial solutions, and many companies that we have in the portfolio, I would suspect that either yourselves or your surroundings, they would not be familiar with it because they are purely industrial solutions which will end up in consumer-related approaches. If we wanted to simplify to the extreme, let's say we would be more upstream than the consumer trend fund is. We would build the components the consumer trends companies will be using. But if you're too early in investing in those and that awareness and need is not there yet, that technologies and simply awareness is not mature enough, you will not make any money. And if you're not making any money, your portfolio will not grow and it will simply cease to exist. So you might be right, but if you're right too early, then it might be the case that you simply lose everything. So it's extremely important to have a concrete idea when these technologies will become mature enough and that this will materialize in the real economy. But if you're too late, if you miss the train, yeah, you can always try to take the next one, but it is extremely likely that other asset managers will have had the idea instead of you, and most of this particularly profitable stage of evolution across the product life will have vanished. So if you're too late, sometimes better not to go at all, right, if the party is already over. So it's extremely important to have this sense of timing. I'm not talking about short-term timing, but to have a sense of awareness and when this transformation, this structural change we were talking about earlier will happen. Last but not least, you see the word regulation, and here you're probably saying, yes, this guy is definitely going to be boring. I'm sorry, but regulation is a very strong growth driver for anything that we do. And this is related to the fact that being sustainability investors, investing in these sustainability trends, we see that we will, going forward, it's not always being the case, but going forward, have regulation on our side. In every region of the world, in every sector, most regulatory measures and announcements, investment plans favor sustainability topics. So that's a very strong growth driver in the sense that for the automotive sector, for instance, I will give you an illustration in a minute. This can be the missing piece of your puzzle, and technology is there, consumer awareness is there, but for some reason it's still not taking off. If you are addressing any topic, yeah, maybe regulation is not taking care of it. But with regards to sustainability and the role of environmental and societal topics across the board, regulation has become a very positive factor for investing. So you need not one or two of these ingredients. You need this combination of all three to be able to build a consistent thematic strategy. That's our strong belief. But a consequence of this, and to continue on what Ed explained already, what could you expect from a thematic funds? We would not define ourselves or differentiate ourselves describing this or that sector or this region, or we might have biases, but they might change over time. Where we think we are different from, let's say, mainstream global equity funds is the type and profile of companies we invest in. We invest in what we call quality companies, that goes without saying, but in solution providers. That's the key word. The type of companies we're looking for are these companies providing solutions to the sustainability challenges I was mentioning earlier. So what we expect concretely from a company is not really to do less worse than its competitor. It's really what the value added, the value proposition from this company towards a more sustainable world and the theme or challenge that we are addressing. Therefore, we are less interested in how the company reacts to its own environment. Of course, that's important, but the question we ask to a company is, what is your impact on your environment? How are you changing things? How are the products and services you provide? And that's a very different type of companies. So theoretically, all sectors are eligible to our funds, right? We don't mind that a company belongs to the industrial, the materials, or IT sector. What we want is to spot is the value added of the products and services of these companies. So from here, I'm going to take you through a few examples. I picked some slides from various presentations that we have from Robeco, Switzerland, to provide you with some concrete illustrations of where we invest, but also what you can expect from thematic funds and what could be their role with a slightly different approach because, well, Ed is extremely popular already. You are all familiar with consumer trends, so I think it made sense that Ed addresses the content of the portfolio, so did Jack. You are obviously less familiar with what we do, so I'm going to present what we do at a higher level, and next time I'm here, I'll be happy to dive into this or that strategy. Maybe the time is not ripe yet. First example I wanted to give, it's about disruption. That's relating to what I was saying earlier about technologies and high level of innovation. Through our product range, you will address many sectors that are or have been or will be disrupted. And that's exactly the case. We have really a case in point with the automotive sector, in the sense that we were fairly early, I think, in believing that the automotive sector would turn towards a full electrification. We launched, you can check, I'm not talking now years after saying, yeah, that we always thought about this. We created a fund, a smart mobility fund, in late 2017. And by then, we faced a lot of skepticism. It would take me the whole afternoon to describe all the reasons why it would never work. So these electric vehicles, it was polluting more. There was no appetite from consumer. It was too expensive. The resources, lithium, cobalt, etc. It was polluting the environmental footprint. Would be much worse. I mean, it was an endless list of reasons not to change. Even traditional auto manufacturers were saying that it was more smoke than fire, and that at some point, yeah, everybody would cool down, and that we would go back to the good old automotive model. And then what happened? You can see this trough here, 2020. So unfortunately, and we certainly don't mean to be any cynical about this, the pandemic was the game changer and really the turning point here. Because of the pandemic and this total disruption of procurement and supply chains, most industrial groups and of them, among them the automotive manufacturers, they had to face strategic choices. So almost all of them in 2020, they decided to move towards full electrification versus the existing situation, which was a partial electrification of their range, but continuing with the old way, so to speak, to build cars. And they did not benefit from economies of scale. They were not, the capex was still not directed towards electrification, so it was not working. But from the moment they decided to shift the capex to say, okay, let's leave behind all this, and again, regulation had a role to play also, because notably in Europe, this Euro 6 standard came into play. So that was only one more reason. And that's exactly the spring of 2020, where all the auto manufacturers at once decided to compete with Tesla. Just check in the press, comments on Tesla from auto manufacturers before that period. They were saying, yeah, it will never work. They don't sell cars for real. It's only for a few wealthy people wanted to have fun. It's never going to work. Just check where Tesla is now. The combined market value of Tesla is the equivalent of all their competitors, because everybody understood that Tesla is not an auto manufacturer. Tesla doesn't build cars. Tesla is completely vertically integrated, and what they do is electronics, no more, no less. That's all that they do. And now, Volkswagen, all the German manufacturers in general, they openly compete with Tesla, and they admit Tesla is the model to follow. And the CEO of Volkswagen, no later than last week, said, yeah, you really have to be dumb to buy a nice car, ICE standing for internal combustion engine at Volkswagen. And again, I would like to congratulate my colleague Ed. Well, he told you about his cat, so I can tell you about his car. He made the right choice by buying an electric car from Volkswagen. He will send a picture next time. So perfect example of how to capture disruption, and the automotive sector is a case in point. What does that mean, this electrification of the automotive sector? It means that we will need more lithium, because the electrification of the sector is based on the lithium-ion technology. So you have many underlying technologies using more or less aluminum, more or less nickel, sometimes manganese, sometimes more or less cobalt. But lithium is everywhere, and this has become the strategic metal of the decade, and this will remain so, most likely. So where can you invest in lithium? What does that mean? The beauty of a thematic fund is that regardless of the country, region, or sector diversification, you can get and capture another kind of diversification, which is diversification across the value chain. So if you want to have more exposure to lithium spot prices, you invest in a lithium producer. But if spot prices are coming down, or it is likely that they will remain low, yeah, you can also invest in a battery component manufacturer, such as a catalyst or cathode manufacturer, not to mention the investment opportunities in battery packs manufacturer. So you have this ability to steer towards this or that stage of the value chain, and that's also a very strong driver, this diversification, regardless of regions or sectors, sticking to your investment thesis, so electrification of the automotive sector and a lithium bet, you can get diversification through the type of companies, again, you will be investing in. But it's also about semiconductors. As I was alluding to before, an EV is no more, no less than a computer on wheels. You have no hydraulics, no mechanics. If you are the kind of person liking to tune your car on Sundays and check what's in or changing this, you're going to get so bored with an electric vehicle. For people like me who hates that, well, you will probably receive an email someday from Amazon, Apple, or whoever will have manufactured your car in 5 to 10 years, saying that they just sent you the block number 40-something, that you will need to replace it, because as they know everything about your car, they have all the data relating to your car, they detected that it was time to change. So these semiconductor components, and especially these power semiconductor components, will be key in electrification. And again, if you want to play the electrification of the automotive sector, but this was already very well explained by Ed, the thematic approach will lead you towards picks and shovels, right? Not the gold itself. And that's exactly what's happening now with this power semiconductor. But the automotive sector, not limited to, but notably, it's also about big data. An EV is completely connected. They have a connection with you because they will ask everything about you. All your data will be stored in your car. And its connectivity also from the car towards its environment in what we call a smart city, right? All these captors, sensors that will allow the car to, in a decade, also become autonomous, but also to simply change lane, anything that we call driver assistance. This requires a lot of data. And this data is extremely energy consuming. So it looks simple, but all this data that surrounds us, it needs to be transferred, it needs to be processed, and it needs to be stored. And we don't know because we don't want to see it, but it's actually stored somewhere. You think it's in the cloud, but the cloud is somewhere in the end. And it requires a lot of efficiency devices. And guess what? This leads us again to semiconductors, because you need these power semiconductor components to make all these devices more efficient. So what's the main takeaway of all this? Simply that if you want to have a bet on energy transition, maybe automotive manufacturers or maybe these big energy groups are not the best way to achieve this. It might be best to invest with these picks and shovels. In that case, that would probably be the semiconductor space. Would you have expected it? Probably not, but it is so. But it's also thematic investing. It's also about addressing risk, because there are risks to the semiconductor manufacturing activity. We've seen that in 2021 with some shortages in supply chains. But we've been asked a lot also about the environmental footprints of the semiconductors, right? We have teasing clients sometimes. They like to question us about what we do, because if we claim that we are sustainable, then they like to believe we are not completely sustainable. And they ask, okay, I've heard that with the typhoons and floods in Taiwan or Southeast Asia, then manufacturing activity had stopped. Correct. Producing integrated circuits is very water intensive, close to 20 liters per chip, which is huge. So what do? Do we, in the end, call it off and don't invest in semiconductor companies because it's not optimal from an environmental standpoint? No. Through our water strategy, we do invest in solutions to treat and filter water or to recycle the water that was used. And therefore, most of the companies that we have in the equipment goods cluster of our water funds, they work with these integrated circuits manufacturer. So that's where you kind of close the loop, is that addressing one sustainability issue will lead you to another one, and that will lead you to another one, and you should also always expect that the next one will be coming. What our job is to always look for the next solution, and if possible, always thinking ahead of such solution. So about water, of course, we invest in infrastructure, equipment, but we also invest in quality and monitoring. All these environmental services and healthcare companies that have become so instrumental, and we've seen that with the pandemic, to the water and healthcare sector. And talking about the pandemic, it's also our job as thematic investors to think ahead and model what was the exact impact, because it's not so difficult eventually to think, okay, what was the impact of the pandemic on this or that sector? It's not always clear-cut, but it's not that difficult to see what it had, the impact on the food sector, on the retail or activity sector. And our colleagues from Consumer Trends did that perfectly. But what we want to insist on from a thematic and sustainable thematic standpoint is that it's never as simple as it seems. So on the healthcare sector, you had the pure impact, let's say, what you can see on the left. So in terms of research, in the long term, this will be huge benefit because it enabled us to, well, these big pharmas or biopharmas to develop these ARM technologies. So that's a huge progress. Also, medical equipment fully benefited from it. But an area that was probably underrated is the social aspect of pandemic, which will require other solutions in the long run. So in the food sector, activity, or hygiene sector. And that's also as many opportunities for us within our healthy living strategy to seize, and not only think in terms of pandemic and its negative effects, but also the needs that will come afterwards. So the last slide for me will be, and to close the loop, will be about being more circular. So this is pretty difficult to understand. Myself, I don't think I would be able to recreate this one. But we haven't found a more simple way to address it. This pertains to the latest strategy that we launched, which is called circular economy. You would not have expected it, right? Because we wanted to capture new sustainable opportunities by creating more circular systems. And the main idea behind this was to go beyond recycling. Of course, to anybody of you, if I had time, I would have asked you what circular economy means to you. Immediately, you would think of recycling. But again, a thematic approach will aim to capture value at different stages of the value chain. It means that we mean to also promote refurbishment, redesign, repair, or shared use of products, because we think at every stage of this product life, we can extract value. And that's the beauty, again, of thematic funds, is not considering this or that sector, but considering a value chain and navigate through this value chain. So that would be the end for me, presenting to conclude the complete range of thematics that we run from our Zurich office. You have 6 of them. Each of them, and similar to what the Trends team is doing, we've built this range, adding building block after building block to keep some consistency to it, always very much anchored into sustainability, which to us, you will have understood, is not a constraint, but it's the exact opposite. This is a very strong growth driver. So I would stop here, and unless you have questions, I would give the word back to Julieta. Thank you.
So, thank you so much. Some final thoughts. I think that it's important and it's clear that we need to start acting now. This is super important. Start having this conversation with your clients. You are not late, so believe me, start having this conversation with your clients and start investing in companies that are conscious about sustainability. They are conscious about governance, social impact. This is the future. So we need to start acting now. And also I want to mention that 95% of all the Robeco funds, they are sustainable according to the latest European regulations, which are more tougher than here in the US. Here we are lagging a little bit, but this is coming. This is something that is coming, and we need to be on top of it. So with that, I want to thank you, all of you again, for your time, for trusting us, and we are here to help you. So if I don't see you before year end, I would like to wish you a Merry Christmas, Happy Hanukkah, Happy New Year, and I hope that next year we're going to be working together. And before you leave, just a 30 seconds video so we can finish. And thank you again. Thank you for your time. Thank you.